I'm going to speak a little bit on a topic that's related to, but different from the preceding two papers. And this is, basically the theme of this is an effort to reframe the way that, that activist hedge funds have been seen. The way that Ron Gilson and I are describing them is that the activists are in fact to be seen as an extension of institutional voice. And so for those who take a view about the institutionalization of markets, particularly US markets, the activist hedge funds are essentially not at war with the institutionalization or taking advantage of it. Rather, they provide special value, that they provide specialization to address the governance failures associated with institutional investors. And rather than trying to encourage the institutional investors to undertake governance roles for which their economic incentives always put them at war with. Rather, we should look for specialization of governance roles and and we think that the activist hedge funds and the others, in fact, play that role. So that's the general theme of the paper. As I say, it's joint work with Ron Gilson. Any failures, I'll leave it to Ron to figure out later in the redraft, but here I am to present the general paper. So, and I've now given you the summary, and for a US point of view, there's underway some rulemaking by the SEC that would crimp the possible role of these activists by making it harder for them to attain a toehold block of significant size. And so to some extent our paper, although I think the implications are more general, also plays against the particulars of US rule changes that the Securities Exchange Commission is proposing. Okay, so this is some general attack on the way that the financial crisis has led to a misunderstanding of the failures or not of governance, and in particular the governance response that we've seen in the US, in the EU, to say governance has failed, we need a whole round of prescriptive governance change. Our view is that that's a mistake for lots of reasons, and this paper is an effort to take a non-panic view of what of how governance can work. Part of our basic claim is to see governance and capital markets as involved in sort of a dialectic relationship. That is, capital markets change, governance must change as well, and the completeness of capital markets, to which there's been a lot of push, will have different implications for governance. In some ways, the capital market completeness improves governance. So, for example, the market in control has been facilitated by the rise of certain forms of alternative finance, which make it easier for an entrepreneur to challenge the existing management group for control. And also derivatives markets, which allow managers to lay off certain forms of risk that they have no control over, lets them do a better job, and lets us do a better job in monitoring them and performing those roles for which they do have perhaps special skill. But on the other hand, innovation we see in capital markets can actually reduce the usefulness of current governance arrangements. And so our basic point is that high-power diversification that institutional investors provide can give rise to a new set of agency costs. And it's that really which this paper attempts to address head on. Okay. So the agency costs of agency capitalism. That's sort of what, yikes. That's the buzzword that we're trying to introduce into the literature, I guess. And so we'll have a little trademark beside it. And let me try to get us to back where we are. Okay. So in the US case, what we see is the rise of institutional investors and the reconcentration of equity ownership. So we moved away from the classic model of dispersed ownership to a concentrated form of ownership. And the reason for that, at least in the US case, has much to do with changes in the way that retirement savings are done. So retirement savings in the US, rather than socialize them, or at least add to the socialization of them already existing in Social Security, pensions are run at the firm level. And indeed, there's also been a shift away from defined benefit plans to plans in which actually the employees are at risk, particularly with IRAs. And that investment, pension fund investment, whether at the firm level or the employee level, has taken place through mutual funds. And so what we see here, it's very hard to see on screen, is the reconcentration has taken place basically on two dimensions. First is the degree of to which the institutional investors own the market. And so for the very largest firms, the institutional investor collectivity owns about 65% of those firms. And what we see even more remarkably is that for many of the largest firms, 25 institutional investors hold what you could think of as a control block in those firms. So literally, the reconcentration of ownership has taken place both across the sense that institutions as a group own large firms in the US economy, but also it's possible for many of those large firms to have 25 people around a room, smaller than the group that's assembled today, and have them basically be able to control the destiny of many of those very large firms. And here we're speaking about Exxon and Apple, GE, very, very large firms indeed. We don't see it though. We see basically the institutional investors for the most part acting in quite a passive way. And here again is because of the kind of agency costs that we identify. So in the case of the canonical Burley means firms, we see the agency costs expressed here. There is the agency costs expressed between managers and diversified shareholders, and there's a familiar story about the efforts the struggle that diversified holders have in assuring that managers act consistently with their interests. Well, there's a new sort of agency costs injected by the role of these diversified institutional investors, because not only is there is an agency of cost between the institution, which is the record holder, and managers. That's analogous to the holders versus managers on the left-hand side, except notice, in a sense, the institutional investors are concentrated enough that you would think that that source of agency cost would be diminished. But actually, perhaps not, and that is because of the separately arising agency costs between the institutional investors and the beneficial owners for whom they're supposedly acting. And so what we describe is a form of institutional owner that we think of as reticent. So the agency cost, the particular agency cost associated with the institutional investor, the right-hand side, is because the business model and the resulting expertise that the institutional investor develops stands in the way of active stewardship. I'll describe that in more detail later, except we see the evidence for it in the mutual fund case, which they hold 30% of all U.S. equities, and yet they barely ever make a governance-related shareholder proposal. On the other hand, we see the positive potential for the story, and this is where the activist holders, the activists will come in, is that although they never initiate such proposals, they frequently will vote in favor of them. So we see them not as passive holders, but as reticent holders. So the characteristic agency cost story arises precisely because of the business model of the institutional investor, which is, and here we say it, to deliver risk-adjusted superior performance net of costs metered in relative terms. So that's very important. Your performance as an institutional investor, how you're going to be judged by the shareholders who hire you, is how you perform relative to your peers. You're benchmarked against a standard measure that involves a peer benchmark. And so what that means is if you discover information that the firm is undervalued, that with an improvement of a particular sort it could increase value, you have two choices to make. One of which is to undertake a governance initiative to improve the value of the firm, the other of which is to use that information and sell, or to underweight that firm in the portfolio that you have. The point that we make is that the incentives of the institutional investor is basically to sell, is to use that information for trading, not to engage in governance performance. Why? Because if you engage in governance performance, you'll be consuming resources, which is going to reduce your relative performance, and if you're correct, and you improve the performance of the firm, then essentially all of your peers will also see the increase in the firm price, but they won't have incurred your governance costs. And so they will necessarily do better than you, even if you're right about how to improve performance. If you're wrong about how to improve performance, then of course all you have done will have been to burn costs. And so the private motives of the institutional investor evaluated in this way will always mean that governance improvements on this structure of ownership will be undersupplied by the institutional investor. The consequence, again, going back to this model, is that the agency costs on this dimension will lock in agency costs between the actual owners and the managers. All right, so now here this is not to necessarily criticize the institutional investors. It's just, it's just sort of the nature of the beast, and the question is how to solve it. One way potentially to solve it is to sort of go on the bully pulpit and say the institutional investors should do that for which they have no incentive to do. And that seems to be the present approach throughout the world, is stewardship codes, et cetera, et cetera. The other is to look to an alternative institution that can essentially provide a specialized function to pick up the governance role that the institutional investors are, by their basic structure, ill-suited to perform. And here is where we make the case for the activist shareholders who can take advantage of the undervaluation of voting rights by the institutional investors. So what's the activist model? Basically, it buys stock whose stock reflects the underperformance, but also the undervaluation of the governance rights, uses the governance rights to increase value and thereby increase the returns on its stock, but also increase the returns on the other institutional investors who hold the stock as well. Now, this is the critical point. The activist model does not involve getting control or even a large enough block that would in itself be sufficient to put forward the governance change. So in effect, the purchase of the block gives them credibility to pitch the case to institutional investors who are the majoritarian owners of these firms, that they have a way that the activist approach will in fact increase value. So part of what happens is that their block ownership positions taken, there's a silent effort that goes around among all the institutional investors, sort of a plebiscite that occurs out of plain view, in which the role of the activist is to try to persuade the institutional investors that there's a better way forward here. And if the activists can assemble a sufficient group of institutions who are willing to go along, that's the point at which the fight becomes a public fight, and the activist may go after board seats or make a public push to try to have a control shift at the firm. And so there's an empirical element of this that we cite in the paper of someone who's actually done research that suggests such a pattern is underway. And when you talk to some of the activists personally, they'll confirm that this sort of the silent period is when they're actually making their case to the institutional investors. Okay, so the policy implication here is that in order for this model to work, the activists essentially need a return, and thus the size of the toehold that they can get before they go public, or before they begin to, before they go public with their efforts, is a critical part of making this particular model work. And thus we point out that there's efforts in the US, the EU and the UK, which would have the effect of, by cutting back the amount of stock that the activists can acquire before they announce their public ownership, after which point the stock price will go up, and thus their returns on subsequent investments will go down, that actually the effort to so-called, quote, protect investors, as it were, will have the effect of defeating the way in which the market is trying to overcome the incompleteness in governance rights that diversification at the institutional investor level gives rise to.